Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. Today, I'm privileged to have Ian George, who was a guest on the show before, come back to return and share some advanced ideas with using life insurance.
Yeah, so one of the things that you and I had discussed, and something that's been going on in the market that seems to be working well for people, is a number of insurance companies have policies and their whole life insurance contracts at their base. So that's where we're starting. And what they are is they're high-early cash value policies. So with policies like that, what you have is you have essentially anywhere from 85 to 90% of the first year premium goes directly to cash value. So if somebody's premium were something, say, I can use a lower number like $1,000 and say, you took $1,000 and you wrote a check, your cash value automatically is going to be, if it's a 90% program, would be $900 in cash value. Where that can become effective in bigger numbers is for business owners. So a number of business owners use life insurance to secure policies for key man, which is making sure if something were to happen to one of the important people, and actually key person is the right way to discuss that today. Right. So key person policies that essentially make sure that if something were to tragically happen to one of their key people, they have the financial resources to help replace that person or to replace lost revenue generated by that person. The other aspect that comes up with business owners is a lot of times they use life insurance for buy-sell. So that's when you have a partnership of one or more, obviously two or more partners, that if something were to happen to one of the partners, that the life insurance creates cash so that they can buy out the survivor. And that way the company stays whole. The money's there to make sure that the survivor is covered. Traditionally, or in a lot of cases, people use term life insurance, which is fine. That can be a great product for that position. Where the high early cash value can come in is that there are a number of companies today that keep a lot of cash on their books for a whole host of reasons. A lot keep it as their emergency reserves. They just want to make sure they always have cash on there to make payroll. These are usually more mature companies in terms of what goes on. Newer companies, obviously, as you're just getting things started, don't have a lot of excess cash flow, don't keep cash on the books. They're doing everything they can, and that's where term life insurance is a great fit. But for the business owner or the partnership that has a lot of cash on their books, and we find that with wholesalers, we find that with construction companies. There are a number of different companies. As a matter of fact, most mature companies keep a certain amount of cash or emergency cash that's just always there. They just want to make sure it's there. Whether there's a lull or something happens, they want to be able to make payroll. There's a number of different reasons to have that. So that cash sits on the books for years and years and years, and it's there to do its job, to be the safety net. Well, what this policy does is you can actually start by using the high early cash value to cover the risk that you want to cover. So as we mentioned before, if it was a buy-sell or a key person policy, you want to get the life insurance. But with term life insurance, you take a look at it, and every year you're paying that premium. And term life insurance has no equity, so it's pure risk. So as I'm paying that term, it's making sure that everything's covered, and it's just as important, but there's no exit strategy. For companies that have the cash, this can be more efficient because what they're doing is they're actually meeting that goal by paying the premiums that are going into cash value, and it's creating the life insurance to cover the individuals that they want to cover. The nice thing about this is, and the good news for most people is that there is less than a 2% chance that somebody is going to die while they're in the saddle. Okay. So a lot of times that frustrates people in terms of what they're spending on the term life insurance. The it doesn't make it any less important because, there still is a 2% chance, and a lot of companies can be ruined with the loss of a partner or a key person in those areas. So they still want to make sure they have the coverage. But in this particular scenario, over time, what you find out is that the difference, that 10% is essentially what you're paying in that first year.
Okay.
Might be a little bit more than you would spend on term insurance, but because that same relationship of your premiums paid and the money going to cash value over time, what people will find out is that by around as soon as the fourth year with many contracts, they actually have most of their money sitting in the cash value of the policy that they've put into the policy, whereas term is just constantly going out over time. Mm-hmm. So, for example, over 10 years, you're ahead of the game. In many cases, all of your money is sitting there. So in 10 years, you find out that you've put money into this policy. There's all your money. There's the death benefit. So your net cost that you've spent on it is essentially zero.
Okay.
Now, some of the questions that always come up when we talk about whole life insurance is, well, couldn't I take that money and invest it better?
Right.
And the answer is, it's very possible. The difference is that the money that we're comparing here is money that was going to be cash. So it needs to be very liquid, and it needs to be ready to get their hands on. As we know, when you're investing money, that's not the dollars that's not how those dollars work.
Right.
So this is a comparison to cash, not to investing.
Okay.
This is basically saying, look, if I have a cash account and my term insurance versus this type of contract, what serves me better? And what will happen is you'll find out that the higherly cash value policies tend to create higher efficiencies because it's less that they're spending out, that they're spending.
Right.
The other thing too is that the companies that have these policies, many of them are mutuals, so you're going to get some dividend growth in there. But the biggest aspect that grows that is it's the old penny saved, penny earned.
Right.
I haven't spent that money on the term insurance, so that factor is also sitting in there as well.
And the dividends are not guaranteed.
Correct. Not with any carrier, although there are carriers that have these contracts on a more fixed chassis, so that, but they're non-participating, and that's up to the individual business owner to see what they like in terms of how the policies are built. Mm-hmm. But correct, dividends are not guaranteed. But even on a guaranteed basis, these contracts start with that, the 90%, that's guaranteed.
Okay.
So that part of it, with virtually all the contracts I've seen, that aspect of it is guaranteed.
So people come to you, business owners come to you, individuals come to you, you evaluate and help them evaluate the different types of coverages and policies, whether it's a mutual or...
Correct.
Okay.
Yeah, so we take a look at what's most suited for them, both in terms of, there's two sides to those conversations always. The first one, obviously, that comes down is the math. Does this work? What's the track record? How do these things really break down? The second part, quite honestly, is simple comfort level. Mm-hmm. Most people start to get very uncomfortable if they're doing things that they don't understand.
Right.
And that doesn't work well for anybody.
Right.
So the nice thing about these higherly cash values is these types of contracts are actually really simple in terms of what they're doing. You see exactly where the money's going. You know who the carrier is. It's just the way it's all sitting there. The other thing too is that with whole life insurance contracts, no matter who is offering them, there are not surrender charges associated with that. No one's going to charge you money to get money out of your cash value.
I was just going to ask you that, if you can explain, people think whole life, they think committed money long term, can't get your hands on, and you're saying higherly cash value, but you're also saying for business owners who have that money sitting aside for emergencies. Can you explain the liquidity provisions in here?
Absolutely. So what happens is the money is in there. So if you look at let's use my example and let's fast forward to the end of year 2. And let's make the premiums a little bigger for a business owner. So they're putting in $10,000.
Okay.
So the first year they spent $10,000 and $9,000 is in cash value. The second year they spent $10,000 and another $9,000 went in.
Okay.
And there's probably a little sprinkling of dividend in there, but by year 2, probably not much.
Okay.
I mean, I haven't seen many policies that have a whole bunch of cash value at that level for this type of plan. But, so there's $18,000 in there. The question then comes into, can I use that $18,000?
Right.
The answer is absolutely. It's liquid. Now, the first thing that there are a number of ways to access cash values of a policy. One, obviously, is you could just say, well, that didn't work. I need all my money back. I'm canceling it. Get rid of the life insurance and send me my $18,000.
Okay.
That's not usually what happens.
Okay.
Usually what happens is somebody says, I want to access that. So with whole life insurance contracts, the first aspect that people have is that dividends that are paid into a whole life insurance policy can be accessed, and those are tax-free under current tax codes.
Okay.
So what happens is any dividends that are in there, they can take out, and that's basically all they're doing. They're just pulling their dividends out.
Okay.
Now, in my example, in year 2, out of their $18,005, there might be $5 in dividends in there, so that's not going to work too much.
Okay.
However, what they can do is they then take a loan. And with most of these carriers, what you're going to be doing is figuring out what their loan provisions are and how they work.
Okay.
But the types of carriers that we normally work with essentially will continue to pay you dividends and leave the policy alone, and you're basically getting a loan from the insurance company based on that policy.
I see.
So you have access to your $18,000. It's done with a phone call. Different companies have them set up in different ways, whether it's going to be a check mailed to you, or if this is going to be more ongoing, they might even have it set up so it's directly deposited into someone's checking account.
Okay.
So there is an interest rate that's going to be attached to that.
Right.
That'll be attached to that loan.
Right.
The dividends are also continuing to pay on those policies too. So there's a net flush in terms of what they're doing with that.
And is it true that the interest on the cash value that's in the policy is still earning interest?
Correct. So the base policy is continuing to grow as if nothing has changed with most types of policies that we would use for this.
Okay.
There are different, and that's something that you do have to look for. You have to understand the loan provisions of the carrier that you're using for this type of coverage.
Okay.
And that's something that people have to understand. So that's one thing that people can take a look at in terms of how it works for them. Additionally, as everything continues to grow, the point about the cash value is that you can also, after you take money out, you can push money back in.
Okay.
So it can be in and out. It's not a stagnant account. It's not locked away, as some people think. You can pull money out, push money back in, everything along those lines. So it's an active account that people can use.
Okay.
And for a lot of business owners, it can be that account. Now, I will say this, when we talk about what goes on, and so let me use an example. Let's say we have a contracting company that says we keep, on average, we keep, $600,000 on our books. My question will be, what's the lowest that ever gets to? So let's say throughout the year they have different things that come on and they go, well, we've really never let that get below $200,000. That's our true safety area. We keep cash on it, but there's some interaction with that first $400,000. The conversation I would start to have would be about that $200,000 base.
I see.
Because what you don't want to do is create any kind of additional vehicle where it's going to be needed immediately.
Okay.
So, for example, when you need cash on hand in the very near future, nothing beats cash on hand.
Okay. Okay.
So that's a key point in that as well. The interesting thing too is that these types of policies also work for individuals.
Now let me ask you, before we get into the individuals, back up a little bit. If we take the loans out as a business owner, must they be repaid?
No, they do not. You're going to see how they affect your policy. So that's going to depend on a couple of things. One is the interest rate we talked about, the dividend rate of the company in terms of what's going on. So you're going to be able to see that right when you're doing it. There's nothing, you don't pull it out and then find out what happens. You'll know before you take the money what that looks like. The other thing too is depending upon how much money you've taken out of the contract, and how you're using it in terms of using this particular contract, you'll be able to judge what goes on with it. So what I mean by that is over time is if it were later on in the policy, and let's say there were hundreds of thousands of dollars in there, and you were accessing, portions of that,
Right.
you can see by paying the premiums or not paying the premiums or what you can do with the policy of how it would affect it.
Hypotheticals.
Yes, you get and they're hypotheticals with current numbers.
Okay.
So there's not a lot of at that point in time when you're stress testing a policy, you're taking a look at it to see how it's functioning and what do I want to do.
Right.
You at least know in this environment. So, for example, if somebody who's doing that this year, they would know based on current dividends, current interest rate, what does this all exactly look like?
Okay.
So they can make those decisions and take a look. But what they'll find is that they're pretty sturdy contracts.
Okay, let's say we have a business owner. With your example, $600,000 fluctuates, but $200,000 as a base, keep on hands at all time, but not their most immediate
Correct.
use of money. It's getting thin if they're getting down to that level. So we move that $200,000 theoretically, and we're saying we're using that in this whole life insurance high early cash value product for additional enhanced benefits on that cash other than where it would be used right now, which is only the benefit of the cash. Here it's subsidizing a life insurance purpose also while still enabling access to that cash. I understand that. Now let's take the example where they never need that cash. They thought they might, but they never do. And it pushes out and pushes out over time. What happens after time when it turns out they never really needed that? Here they've been making the deposits every year, and they shift those over and they've bought the life insurance. And 10 years later, let's say, they've still never needed the cash, but they always had it. Where do they stand on the life insurance in some cases? Because term life insurance would have run out.
Or become very expensive.
Or become very expensive.
Even on for, so you have 10 years and even in 20 years you can see, examples along those lines too where people have been paying that premium to cover that 20 years. So they bought a 20-year policy because you have two partners who are in their 40s and they're saying, hey, we want to make sure we get this out to our 60s. So even, so to those examples, and actually what you find is that is more often the case.
That's what I was thinking.
Than not.
Yes.
So here's where the really nice side effect of all this comes on. So to your point, why did we go down this road in the first place? The reason we went down this road in the first place is somebody had demonstrated that I could have my cash create the security that I want of what cash does.
Right.
I haven't given that up because there it is sitting in the policy and I know I can access and call it up. Secondarily, it's now bringing a death benefit, which is another risk I wanted to make sure it covered.
Right.
So we've gone down the road and now I'm looking at this and I haven't used it and now there's a transition coming in my business. So I have an individual who's ready to leave. So let's say that it's a buy-sell agreement and we have two individuals who are, they've determined that, and maybe they're different ages, maybe there's a host of reasons, but one partner is now like, I think I'm ready to, I'm ready to retire. I'm ready to go on and do something else.
Okay.
So this policy that is on that individual is sitting there, and it's on the company's books. It's owned by the company. It's sitting there. They can do, it's just cash. So what the company has the ability to do, that the partnership can make a decision of, is this is an asset that we have.
Right.
So I need to be able to pay my partner so that I can own more of the company.
Right.
So a lot of times what we find is that in partnership programs along these lines, they actually pay the partner with the whole policy.
Okay.
Now the advantage that the partner gets there is obviously the cash is the cash.
Right.
So for example, if I owe my partner who's leaving, and we have one of these policies, if I owe my partner $1 million to buy out the rest of the company, and there's a $500,000 sitting in the cash value of the policy, well, he takes a $500,000, and then we're going to find a way to take care of the other $500,000. And oftentimes that can be done in cash. Usually we find that it's done in step payments, over time.
Okay.
The great thing for the partner who's leaving is that, excuse me, they've received their cash, their compensation for their portion of the company, and it's right there. they're also walking away with a big chunk of protection that they can use to leverage how they're going to retire and what they can do. And it can also be a great plan for a legacy plan for their family.
Because they can change beneficiaries. So early on, it may have favored the business. Now it can favor their family needs.
Exactly. So they're going to be the owner of it, and they can name their beneficiaries. Could be their spouse, could be children.
Where
They could
again,
put it in a trust.
term insurance and Invest the Difference would not have satisfied that need because of the weakness of the term insurance. Those fixed rates on term insurance premiums expire. They either, those policies end and you're out of coverage. For later years, you don't have that planning opportunity. Or like you say, it's way too expensive and it'll price you out.
Right, and if you did and you have to remember the dollars we're comparing here too, which is so if I have a cash account and a term insurance, and I bought term and had cash.
Right.
So now I'm just drawing down, if I'm doing the math, I'm just drawing down on what I pulled out of my cash.
Right.
So now I have no life insurance and less cash.
Okay.
So
You know, the two major, really, I think, efforts that every business owner has, every successful business owner. Number one, there are two common themes that I run into. Number one, make our money work for us. We don't want dormant money. We don't want money sitting, but we need high liquidity and we need safety. So number one caveat that I see most successful business owners saying is, make my money work for us. The second is, we don't want to pay taxes. Those are the two caveats that I see most successful business owners saying, and this seems to fit into, not for everybody, but as an additional tool that may be appropriate for solving multiple needs, you know, with one stone, so to speak.
sure, and the nice thing about it is that there's so many different ways of using that on the back end. Mm-hmm. Because what you have is cash in the cash value of the policy that's earning money,
Right.
and a death
Not
benefit.
currently taxable.
Correct.
So it helps on the books, on their tax issues.
Correct. As a business-owned policy does not owe taxes on the accumulation of the cash value. Mm-hmm. The other thing,
And in addition, the money's working for them to help offset a separate, unrelated need that some business owners knew they had, which was either having to pay premiums for a buy-sell, buyout life insurance or the key person life insurance.
Exactly.
Anyway.
Exactly. So that's where it becomes very effective for them. Mm-hmm. And again, on the transition side, you basically have all the cash that you had plus some, right. And you have the leverage of the death benefit that they can use however, you know, that's only limited by the imagination of the individual who's using the contract in retirement and how they want to use it for legacy planning and things along those lines.
So it is an opportunity for some to leverage their cash accounts.
Absolutely.
Yeah.
Absolutely.
That's good.
And it's keeping it safe as well.
Yeah.
So it's not like it's not going into anything that is associated traditionally with risk.
It's an interesting strategy you have. I don't think many business owners or life insurance professionals are really aware of that.
Yeah, it's not. It's we do find out that, you know, once business owners who do have cash, who do keep cash, as soon as they see it, they tend to very much enjoy this concept.
Once they get it.
Well, because a lot of business owners have been frustrated with two things with what they're currently doing when they own term and have cash. One is the cash doesn't grow. It doesn't do anything for them.
Right.
So they get frustrated.
It's shrinking, actually, by not growing.
Correct. The other thing, too, is the premiums they pay out every year for the term life insurance at some point in time can start to get frustrating for business owners because they know they need to make sure that protection is in place, but it just irks them that I'm writing this and, you know, here we go another year that we're doing this. And where it can become very frustrating is if you have somebody who bought a 10-year term policy and it's year 11 and they see those premiums skyrocket.
That's what I'm talking about.
And they go back through underwriting, and this happens, I see this frequently. The business owner who had a policy that they were paying X amount of dollars on that they started 10 years ago goes through underwriting and finds out that they're in good health. They got great ratings and things like that, but when they see the premium for their new policy, they can't believe it.
Right.
This is so much more.
And now it's wasted money.
Yeah, and you're 10 years older.
Yeah.
So
that's wasted money. Now this whole life, that's permanent insurance coverage if you wish it to be. That's permanent coverage.
Correct.
What about the premiums or deposits, though? Because many business owners will see this as an opportunity to reshift money. So they would refer to this as deposits, not as much premiums, because the majority of these are, of the funds that are going in here, are shifting where those funds are placed, and they can be pulled back out. So are they forever?
Well, actually, those policies tend to be, they can be, a lot of them are true paid up policies. With one carrier, it's age 85. Some carriers, it's age 80. Some carriers, it's age 90, where they're traditional, they're paid up policies. Now, the other thing you can always do with any whole life insurance policy that I'm aware of, whether it be a mutual or non-mutual, the whole life chassis itself, how it's built, you can always do reduced paid up.
Okay.
What that means is you reach a certain point in time and you take a look at your policy and you've got cash value in there and a death benefit, and you call the insurance company and go, hey, I want this reduced paid up. If you turned it on and locked it all off right where it is,
Right.
what would happen? And what happens is the cash value stays where it is and the death benefit's going to come down a bit. It depends on how late, how far down the road somebody does this.
Okay.
But it's called reduced paid up because you're reducing your death benefit usually.
Okay.
But
the death benefit that it reduces to, it's the calculation on what the cash value has a paid in full policy.
correct.
Okay.
So
Where no
everything's-
further premiums are required.
No form. Yeah, and after you do a reduced paid up policy, when you do that, you can't put more money in it.
Okay.
You've locked everything down.
Okay.
Now what happens is dividends are going to start growing that again.
Do interest on cash
Mm-hmm.
continue?
Yep. So both your death benefit and your cash value with those policies are going to continue to grow.
Does that push the death benefit up?
It does.
Okay.
So you're going to lock
So
it
you
down
can
here,
stop
and
it.
over time
You
it's going to grow.
Got it. You can stop it. You can freeze it. We get to age 60 or 65 or 55 or wherever we are, and we say, we want to keep whatever the inherent benefits are in there. We want to shift things around. You can lock it down and not have the further obligation.
Correct.
What about if we were not doing that? Is there any other way that business owners can look at this as an asset, but having maybe the interest on the cash value subsidize the mortality cost, or is that not something that most do?
Okay, you can. And so what that does is what you're talking about is what we call premium offset, which is the language that's, a lot of lingo can get very confusing.
Okay.
But what it basically means is that the policy is earning enough internally to pay its own premiums.
Okay.
So the premiums are still due. Okay? What happens is you're just not taking outside money and putting it in the policy.
Got it.
What's happening now is that the dividends and growth within the policy are now paying the premiums. People will select that because what you will see in a lot of circumstances is that maintains the higher death benefit.
Right. Right.
Depending upon when that occurs, what you will often see is you might see the death benefit come down a little bit
Okay.
and then come back up. Cash value is always continuing to grow.
I see.
Down the road, you might not see much of a change at all because the dividends could be far greater than the premiums.
I see.
So everything is continuing to grow. You're just not putting new premiums into it.
Okay.
The nice thing about premium offset, where the policy is now running on itself, is you're creating itty-bitty loans in there, okay? Or sometimes you're having dividends surrendered to pay that, but you're creating a little bit of an opportunity if you wanted it, which is to say if you set that up and then somewhere while you're in retirement, you came upon a great deal of cash that you needed a place to move.
Okay.
You can put, because you didn't lock it off,
Right.
it's still open, you could push money into that.
Wow. Ian, I can't thank you enough. We're out of time for today, but I cannot thank you enough for sharing some of these strategies. Anyone who wants to get in touch with you, how do they do that?
The best way to get in touch with me is that you could contact me directly. My phone number is 412-969-0111, and that's the best way to get in touch with me. Just call me directly.
Okay, very good. Thanks for coming in. Can you come back in and we can go over some of how this can help individuals and things like that?
Absolutely.
Thanks for coming in, Ian. Thanks again, everyone, for tuning in to another edition of All Things Financial. We'll be back again next week.